We've experienced years and years of underinvestment in the commodity area. That we've underinvested in oil because of environmentalism, global warming, all of that stuff. And we've underinvested in mines and minerals and all sorts of commodities. And we've been overinvesting in alternative energies as a matter of policy. So we've thrown in $1 zillion into alternative energy sources and electric cars and so on and so forth. But we haven't really been developing and investing in things like oil, things like minerals and other commodities basically across the board. So I think that there's going to be tremendous pressure in commodity markets moving forward.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're exploring the intersection of the economy, Federal Reserve, geopolitics, precious metals, and the stock market with Dr. Mark Thornton, Austrian economist and senior fellow at the Mises Institute. Mark, it's an honor to have you on Metals and Miners. Welcome to the show.
Hey, Gary, it's great to be with you. Thank you for the invitation.
Absolutely. All right. So, Mark, you're a senior fellow at the Mises Institute. You host podcasts. You're a published author and editor. You serve on academic journals. You're a professor of economics, and you've been interviewed for your expertise on many of the top financial media. What do you hope for those tuning into this conversation today that they're going to walk away with after listening to our discussion?
Well, Gary, I think the Austrian School of Economics has something to offer everyone. And I know most of your audience is in favor of free markets, and they're against government intervention. And what we do here at the Mises Institute is explain how markets work and why government intervention is bad for the economy and bad for markets. And this is something that's been ingrained in the school since Carl Menger founded it 150 years ago, and which Ludwig von Mises, of course, is the greatest proponent of this brand of realistic economics. And I think your audience is going to be able to see that in the market for metals and miners and things like that, where the rubber hits the road. Austrian economists have something to offer, whereas Keynesian economists and mathematical economists, of course, are completely out to lunch and really don't have anything to offer real people, because their economics is not about real people.
So, it seems that the federal government, maybe since the early 1970s when Nixon took us off the gold standard, has pushed out all or any semblance of Austrian economics perspective in favor of MMT and Keynesian perspective. Do you agree with that?
Oh, yes. And it's been in the works a long time. When Carl Menger founded this school, based on his book, The Principles of Economics, it was really the heyday of Karl Marx and the socialists in the 1860s. So that's really when they came to rise. And eventually, it's just been a displacement of real economists talking about real economics by socialists, Keynesians, mathematical economists. And, today with modern monetary theory, if anybody takes a look at that, I think that every man on the street can tell that it's just a fool's errand, basically. But unfortunately, those are the type of economists who are advising politicians, telling them what they want to hear, to spend more, to run bigger deficits, to inflate the money supply as a way to economic prosperity. And of course, the Austrians are saying exactly the opposite.
Well, let's be honest. Austerity which was tried with Doge, it's really a political non-starter for anybody's career in politics. And so they may be being advised in that direction, but that's probably what they prefer.
Oh, absolutely. Real austerity, where the government budget is cut, taxes are not increased, they're decreased. The evidence on that kind of real austerity is actually perfectly clear. It leads to a sharp downturn, but a very quick recovery and much higher levels of economic growth and wage rates, and vibrancy in the stock market. So real austerity, the type of austerity that you and I think of really eliminating government programs, eliminating government regulations, eliminating government bureaucracies, and the taxes that fund them, is the road to economic prosperity, especially starting from a position like the United States, Britain, Europe, Japan, etc., with bloated governments, high taxes, incredible national debts. This is exactly where the Austrian remedy is going to work the best, and it's going to work very quickly and effectively.
Unfortunately, I'm sure we could agree on this. It's probably not going to, be the order of the day until it's absolutely necessary, until everything else has been exhausted. But, the economy, it's growing despite anemic payroll employment gains. Fed projections are, in the neighborhood of 3.5% to 4%. That could only happen if productivity growth accelerates and raises real wages enough to offset the weakness in employment. The question is whether productivity growth will actually continue to do so. What are you expecting moving forward?
Well, the expectations for high productivity growth are based almost entirely on the success of artificial intelligence, that somehow this is going to produce a lot of productivity growth, and it's going to raise wage rates and production levels in the economy. And generally speaking, if more capital, more investment is applied in an industry, you're going to get increases in productivity. Technology, if you employ more of it, it's going to do that kind of thing. But artificial intelligence is a brand new thing, and even the promoters of it don't really know how it's going to create revenue, what are the products that are going to be based on it, so that we know we're going to get some savings in terms of requiring fewer man hours to do a particular task. But, it's a lot of it is smoke and mirrors at this point. Even the promoters don't really have a firm way of explaining how this is all going to work. And so we're very concerned that this type of investment is really leading the way. I mean, without the investment in artificial intelligence and without the investment in data centers right now, the economy is not bumbling along. It's in recession for sure. I mean, you've got more than 50% of the American population in recession. Their real wages are declining. Their purchasing power is being evaporated away. And they're making cutbacks across the board. They can't go to restaurants. They can't buy at the grocery store what they used to buy. So we have the upper income groups, the people involved in technology that are making a lot of money, the people in finance who are making a lot of money, and they're accounting for a huge amount of consumer spending. And so, this is a very top-heavy economy, and I gave a talk recently where I explained, and everybody liked the idea because it's an age-old proposition, that everything good comes from the bottom up, and everything bad comes from the top down. And it's particularly bad when the government does it, when the political leaders impose a solution. But really anything that comes from the top down rather than from the bottom up is a big question mark, Gary. And I'm very concerned. It's a classic case with the Austrian business cycle theory that if you've got a Fed that's inflating the money supply and keeping interest rates low, you tend to get three things. And everybody kind of knows, except for the people at the Federal Reserve, that more money leads to higher prices. And they don't believe that anymore at the Fed. That's how bad mainstream economics has gotten. But that's really only one of three things. The second thing, which is much more complex and finance related, is that these artificial interest rates spur investment in advanced technology. So that's something we've been talking about for decades and decades. And since Hayek in the 1930s, we've been talking about this, how these interest rates reconstruct the whole structure of the economy. We're definitely seeing that. And the third thing that we get from the Austrian theory of the business cycle is exactly the K-shaped economy, where one group, the higher income people, the people with all the wealth, they're experiencing great gains, but the working class is experiencing losses. And so all three major findings of the Austrian business cycle theory are clearly all at work right now, which adds to my concern about artificial intelligence and the data center investments leading the economy into 2026.
So it's a really good point you're making, and I think somewhere I had heard recently that AI has contributed about 1%, maybe a little bit more, to GDP, and that was a greater percentage for anything that was impacting GDP since the height of the dot-com boom. Mark, the stock market is historically overvalued by many measures. The Buffett indicator, Case-Shiller. There's many things to look at here. Many people have reaped much smart money has reaped great gains over the last few years, especially in the Mag 7, and for many reasons, including their valuations, the curious ROI on data centers and AI products like you're talking about, the circular financing that we're seeing, and other reasons. There's a lot of talk that smart money is going to begin to look to book some gains here in early 2026. Things are looking too shaky for smart money to stay in there and rotate into more value and hard asset type investments. What's your expectation here in 2026?
Well, I think that's right. I think maybe the smart money is already moving out of technology, which, the Mag 7 has not been doing all that well in the last few weeks. The NASDAQ has not really been going gangbusters like it had been. It's just inching along, making new highs. The overall stock market seems to be topping. And I wouldn't be the least bit surprised if there was a lot of profit taking towards the end of the year and in early next year, of course, to avoid taxes in this year. So I can very easily see that. And what I'm most concerned about for 2026 is, and this is not on anybody's radar, I haven't heard these words spoken on Bloomberg for months and months and months, which is the inverted yield curve. And of course, we were all concerned about that last year and even the year before, because this has been the largest, most sustained inversion of the yield curve that has ever happened. And of course, it became technically uninverted a few months ago, and nothing happened. The stock market continued to go up. But if you look at the chart, the 2s and the 10s, the inversion, it takes a while for the inversion to actually kick in a real recession, or at least, an official recession. And so I think that with the Fed, cutting interest rates and now announcing quantitative easing on the short-term rates, and if that creates an inflation or a heightened inflation factor in the long-term rates, which it's done in the UK, it's done in Japan, globally, the long-term rates are rising. And I suspect that, of course, President Trump wants the interest rate cuts to reduce these longer-term interest rates to spur investment in the stock market and all that other stuff. But if it backfires, which the uninversion of the yield curve would suggest, that opens up a big can of worms, and we might be seeing swans flying all over the place.
So, it's interesting because that was going to be my next question. If we've ever been in this position before, I mean, we have a stock market near all-time highs. We have gold and silver at or near all-time highs, Bitcoin near all-time highs, real estate near all-time highs. Then we have debt and debt servicing and the budget deficit at all-time highs. We're not exactly in the middle of an economic catastrophe right now, yet lowering interest rates to 1% and doing QE like, Trump wants 1%. And then, the $40 billion that they announced could be just the appetizer. We've really never been here before where it's been this kind of cocktail mix. It's usually, things are going poorly and they need to try to spur spending. We don't really have that problem right now. So what do you anticipate the ramifications to be? Do you think a huge resurgence of inflation is what's coming?
Well, I certainly agree with you. We've had 16 years of a booming stock market. We've had at least 16 years of very easy monetary policy with many years right down there at the bottom. And of course, the federal deficit has been enormous. The national debt has grown. So what we're doing in Washington, D.C. as a norm now in terms of stimulation through government spending, stimulation through deficit spending, stimulation through low interest rates is something that even the Keynesians a generation ago would only apply to a Great Depression type scenario. Exactly. And now we're using it as just a matter of course, as a normal thing. It's just a normal thing that the Fed would come in with $40 billion a month on top of just restraining short-term interest rates as a matter of course. Now they're going to dump an extra $40 billion into that marketplace. And that's now just a matter of course. So again, I'm very concerned about how this is going to turn out and how it's going to look going into 2026. I see a lot of problems, and many of them have already been brought up and dismissed. In the mainstream media, the problems with commercial real estate, well, they papered that over, and, the problems with private credit and private lending, and, the list of problem areas in the economy. These Keynesian solutions have not solved any of these problems because they're only encouraging more debt, basically, in the economy. And they're encouraging more consumption without really stimulating productive investment and Main Street capital investments and those kind of things. So we're not really fixing our problems. We're only adding to them as we go through time.
Mark, let's switch over to oil here. The current Trump administration came into this presidential term with a 3-3-3 policy, where one of the threes was to rein in oil prices to control broad-based inflation. You might recall Besant talking about that. Yeah. They've largely done that, and oil is at an incredible low of around $56 a barrel, which has been, on one hand, good for the economy and inflation, but could cause oil supply problems in 12 to 18 months because of the dynamics of achieving supply. That said, though, with oil involved in almost all products and services, low oil leads to lower inflation. And with all of that, inflation is still above 3% and rising higher, largely because of the fiscal dominance and the monetary inflation that's embedded in the system. What happens if and when oil goes higher because of the supply-demand imbalances and other factors, and with inflation already over 3%? And is this a scenario that you're expecting to occur at some point in 2026?
Yes, I am. And I think we've experienced years and years of underinvestment in the commodity area. that we've underinvested in oil because of environmentalism, global warming, all of that stuff. And we've underinvested in mines and minerals and all sorts of commodities. And we've been overinvesting in alternative energies as a matter of policy. So we've thrown in $1 zillion into alternative energy sources and electric cars and so on and so forth. But we haven't really been developing and investing in things like oil, things like minerals and other commodities basically across the board. So I think that there's going to be tremendous pressure in commodity markets moving forward. This could be just the tail end of lower and lower oil prices. I know that a lot of people are expecting a glut in oil and energy. And the chart certainly does look like it's heading down, but most of those projections of gluts come from official government estimates, and those estimates have a bad track record of actually predicting. So when the government says, or a government agency says, we're on the brink of extinction, or, markets are going to melt down, it's usually something very much the opposite comes along to bite all of us as a result. So due to the underinvestment in a lot of these areas, I'm expecting that commodity prices and markets are going to firm, probably move up, and contribute to CPI inflation, or the consumer price index type of inflation, not the obviously monetary inflation.
Which is not going to go away either.
No, not based on, Jerome Powell was kind of holding the line on monetary inflation, keeping rates from going down for a while. He relented, gave in to President Trump, and now, it's obviously he's gone in whole hog on inflating the money supply. And of course, the president is appointing doves who want to just see a lower dollar. They want to see more money printing. And inevitably, of course, that results in higher prices for consumers. Now, that may all play out after the midterm elections in terms of prices to consumers, but in the immediate time frame, the investments that President Trump is helping to spur and the deregulation that he's helping to spur, that those really haven't had time to work to put downward supply pressure in these markets. So, but that's my expectation, is that we are going to see higher commodity prices.
Yeah, I couldn't agree more. All right. So, Mark, the U.S. experienced its largest deflationary event in 1929. It seems since then that the powers that be will not allow deflation to take hold. To them, it's too risky to have true price discovery. It started to in 2008, and then they went on the historic, printing and spending binge to induce inflation, which they were finally successful in doing so. They did the same after the pandemic. But all of this leaves the U.S. with a lot of many important issues, but there's two that I want to focus on. Number one, an exorbitant national debt, and two, an ever debasing of the currency that puts strain in multiple ways on the economy and the consumers, which leads to many difficult problems, even ones that we're finding today. Is there a way out of this, or do they just keep repeating this in ever larger numbers until the whole thing hits a brick wall?
Gary, I'm really glad you brought up deflation, because that really paints a picture of a stark difference between Austrian economists on the one hand and mainstream Keynesians on the other. Austrians like deflation, and I'll explain why. Deflation is the corrective process in the economy from these large-scale government macro policies. Mainstream economists are paranoid about deflation, and they can't really explain why. The only negative deflation really we've ever had was the Great Depression. So they have one data point, but on that basis, they rest all of their macroeconomic policy and concern that you must fight in deflation. And of course, Japan has been fighting deflation for 30 years, and they've ruined the world's best economy in the process and have driven themselves bankrupt in the process. But basically, what happens in a deflation is that prices are coming down, but it's prices of capital assets that come down the most. So stocks, real estate, land prices, the things that the wealthy own, those fall significantly, 70, 80, 90%. But wage rates come down, yes, but not that much, maybe 10, 20%. And consumer prices don't come down much at all in the process. They come down as well, but you don't get a massive cut. And so the working class people, they get a cut in their wages and they get a cut in consumer prices, but the working class loves deflation. That's why they fight. That's why they shop at Walmart and Dollar General and places like that, because they love lower prices. They love falling prices. And if you look at that world where real estate, land, capital goods are all falling tremendously, wage rates are falling, but consumer goods aren't falling. What that does is it creates enormous entrepreneurial opportunities out there where new entrepreneurs starting from scratch can get their hands on land and real estate and capital goods. They can hire workers who are relatively abundant, especially right after the crash or the downturn.
I don't mean to interrupt you, but I do have a question here on this. Yeah. So, today we have such a highly levered mortgage market. People are, taking out close to 100% loans on homes. They're not putting down 20% like they used to back, in the 60s and 70s. And even though there is some mortgage insurance there that they're paying, the banks are really the ones who are taking on the majority of the risk. So if housing prices fell precipitously in a true price discovery moment, and the people just walked away from their homes, they just turned the keys in and just walked away, what would occur? What would happen to the banks, to the banking infrastructure of the country?
Well, it could possibly collapse, basically, but we would get some of the things that everybody hopes for. We would get much lower housing prices. We would get much lower capital prices, land prices. We would get, again, these opportunities for brand new entrepreneurs. So young people who are incredibly discouraged about the current circumstance of high debt, high future taxes, high stock prices that they can't afford to invest in, high housing prices that they can't afford to invest in. I mean, now it's the first-time home buyers are now 40 years old, and we're destroying our future, basically. And the only way out of that, you can't print your way out of that. You can't finagle your way out of that. You've got to work your way out of that. And that's going to mean a lot of pain for people at the top. And so,
you don't expect them to print at some point?
Oh yeah, I expect them to print, but I'm just saying that this is how you solve the problems.
Okay. I agree.
and exactly your point is they're never going to do it.
Right.
We're going to have to find ourselves, just as we did in the late 1970s, in a period of desperation. And in a period of desperation, Jimmy Carter did some things that were antithetical to the way he thought about things. He deregulated, he privatized, he brought in Paul Volcker, and he basically gave away his chance to be a two-term president. But what happened as a result of that crisis that he helped bring about with Paul Volcker's help is that we bottomed out in the economy. We went through a hell of a lot of pain, and we ushered in 2 decades of really good prosperity. We almost got the gold standard back, but we had high rates of economic growth. We had high rates of economic mobility in the distribution of income. Our stock markets flourished. And so, I'm suggesting a policy that will solve the problems that are currently facing, especially young people, and that they have worked within my generation. And I agree with you that politicians will never do this until they get to the point where they put us all in a situation of economic desperation. But that's their motive. That's not my motive.
I totally agree. We're on the same page. I just think we're very far away from those types of actions being taken by Washington, whether it be this administration or a future one. It just doesn't feel realistic right now. Mark, printing their way out of this mess would be one thing if debt was a small fraction of the almost $40 trillion. But at this current level of constant and absurd money printing, it makes it really hard for foreign nations and other investors to believe that if they lend the U.S. government money through the purchasing of the bonds, that they won't get handed back the original principal that is severely debased and incapable of purchasing anywhere close to the value of goods and services that they originally lent to them. So instead, they're turning to alternative assets that are going to protect their purchasing power, not just today, but into the future. They're turning towards precious metals because of their incredibly long historical track record of doing just that, preserving purchasing power. And it also is universally trusted around the globe. Won't that trend continue and actually increase in intensity from here, since it's almost assured, as we've been discussing, that the currency printing is going to only escalate from here?
Yes, I firmly agree. I mean, I think this is, we could be just at the beginning of this trend in higher precious metal prices. And I think that you're going to see precious metal prices tell the story of how we get from where we are today into that state of desperation where the government has a hard time borrowing money from the economy, maybe just at that short-term treasury bill stage. They're not able to borrow at the 30-year and maybe not even the 10-year. You know, if the 10-year were to go from 4% to 6 or 7%, you know, what does that do to the deficit, the budgetary situation, and the national debt moving forward? So I think,
to the consumer.
Yes, into the consumer, and I think that gold is going to tell the story of how we get from where we are right now to that point of desperation. You know, there's very little in the way that anybody that has suggested that tells me that the politicians are going to change their policies. Exactly. And there's nothing that I've heard or seen or can think of that's going to stop the markets for gold and silver from moving higher in parallel to those policies.
Totally agree.
And so it's going to send a signal out. Right now, Americans don't know about what's happened in precious metals. Basically, they're completely out to lunch.
They really are.
Now in foreign countries, I think they're more aware of this because they're more sensitive to, you know, what the Indian government is doing to Indians and what the Chinese government is doing to Chinese. And
they're also being instructed over there to buy them.
Yes, and so they are encouraged, and it's part of this dialogue. Whereas in the United States, I'm afraid that by and large, people really haven't caught on to this. The silver stackers from decades and decades ago, you know, are continuing on into this buildup of precious metal prices, but the average ordinary citizen is completely out to lunch on this topic.
This is something I've been talking about. And, you know, when you think about the balance sheet of the Chinese citizen, the Indian citizen who does own gold and silver, who's buying gold and silver, their balance sheet is expanding and getting better, while the Western nations, Europe, United States, et cetera, as they own their country's bonds, their balance sheet is getting worse. But Mark, let's move over to AI for a second. I do have a question here. I'm really interested to get your take on. President Trump has deemed the AI race existential and that the U.S. has to win it. In order to win it, we need to modernize the electrical grid that hasn't been updated in more than 50 years, and we really need it yesterday. We don't have the qualified workforce. We don't have the critical metals and minerals supply chain. We don't have the energy, and we don't have the trillions it's going to take to get all of that done and to win the race. The money that is in the capital markets has to remain there for the retirements, pensions, other funds. If they get crushed, it would cause much bigger problems. The debt servicing and the entitlement servicing is already not being met, and we're running about $2 trillion deficits and growing. We have a looming $100 trillion unfunded liabilities issue hanging over our heads. How in the world is the U.S. going to modernize the electrical grid, secure all the supply chain and workforce needs, acquire all the needed energy, and win the AI race without printing trillions and trillions to do so and sparking this next great inflationary wave?
Well, Gary, I think we'll have to ask all of the state public utility commissions, because they've really been in charge of this industry for almost 100 years now. They've been overseeing, rates and investment and, rates of return on capital. It's been a totally government overseen operation. It's something out of a horror movie from the Soviet Union days, really. We have components of our electrical generation and our transmission system that are nearly 100 years old and haven't been replaced. And, I've been told, some people have actually told me that people who work with some of this stuff, that they say, well, the stuff that's, 75 years old is more reliable than the new stuff. So I'm not sure what to think. I certainly can't solve the problem. It's really only markets that can solve this kind of problem, to develop the investment that's needed, to figure out what investment really is needed. I mean, obviously, if we left it to a pure private market system, there would be a much more distributed system of power generation, probably based on a multitude of fuels, but certainly a lot more uranium and nuclear power. This would all be distributed, and big players would have their own generation facilities. And so we would have a much more flexible system instead of, state by state production and transmission. As it stands right now, here we have companies that have been applying to hook up to grids, requesting, massive amounts of power, and basically the local utilities have done almost nothing. And so these data centers in particular, they're going to have to find their own way, their own source of power, and they are. I mean, they're trying, to find ways to generate their power, because not only do they need a source of power, ongoing power, but they need at least one backup system as well. And so, this is a huge problem, and it just goes to show that government oversight, that, we might be lured into thinking that that's the safe way of doing things. Well, in a dynamic world of ever-changing circumstances, what we're seeing right now is that basically that's a lie, and that government oversight has done an enormously poor job. And over time, these problems are now revealing themselves in the fact that the public sector always underinvests in some of the critical aspects of the economy, and then they'll declare an emergency and ask the taxpayer and the ratepayer to pony up, huge amounts of money at a time when they can't afford it. So that's the government playbook. And it's probably the way things are going to turn out, but it's not the way that they have to turn out. And I think we're going to see that states with more enlightened public utility commissions and more competitive, situations within their regulatory systems, we're going to see much better results, and we're going to see the data centers flock to those areas, as well as the industries of the future, which is, I think President Trump does understand this, that we do need energy. We need low-cost energy. We need low-cost power. We've been frittering our resources away on these environmental fantasies, and now we're finding ourselves in insoluble situations with respect to power generation.
Yeah, and it looks like one of the things they're going to do to try to bridge the gap here is over in the UAE, Saudi Arabia, to put some data centers over there and, leverage their workforce to get things up and running quick, their power generation, et cetera. However, those are two of the biggest trading partners with China. So that's quite risky, in my opinion. But in order to battle all of what we're talking about here, Mark, doesn't the U.S. dollar have to go much, much lower from here? And they're going to cap yields on the long end of the curve. They're going to essentially create financial repression. The bondholders are going to be the big losers. And in essence, it's going to spark this massive move and upswing for the precious metals and the downward movement in the dollar versus hard assets, real tangible things. Isn't that what's really inevitable here?
Yes, I think a downward pressure on the dollar is inevitable. For a variety of different reasons, some of which we've discussed, but basically there's less trust in the dollar, and of course dollar-denominated assets now make up a smaller and smaller portion of central bank reserves, and central banks are moving further away from the dollar and dollar-denominated assets, and there's more international trade that's not based on the dollar, so there's a variety of different ways. It's not just the printing press in the United States, but it's also just basically the fact that foreigners don't trust us, central banks don't trust other central banks, and we've got a $38 trillion debt. And, that's also a desperate situation. Do we have to print? Do we have to print to pay off the debt? Do we have to print to keep interest rates at a reasonable level? And, we saw a big jump downward in the U.S. dollar this year, 2025, and I certainly wouldn't expect it. It did recover for a little bit. I mean, it went down to the 96 level, and then it got back up close to 100. So it's very difficult to predict the mystery of its short-term and intermediate-term trends, because everything works its way through currencies, just as gold absorbs all sorts of uncertainties from around the globe. And so I'm anticipating the dollar heading lower, and with President Trump all but stating the fact that he likes, he says he's for a strong dollar, but then he's for a weak dollar. A president that's wishy-washy or straddling the fence on this issue tells us that the trend is definitely down, and I think that opposite that trade is you're going to see currencies that are based in commodities and precious metals and energy are going to be relatively strong versus the dollar. So Canada, Australia, Brazil, maybe, and it's something like that. I certainly don't predict currency exchange ratios or anything like that.
Let's stay on the commodity side for just one moment here, Mark.
Sure.
Okay, so to win the AI battle versus China and accomplish all that needs to be accomplished, the U.S. has to secure the underlying commodity supply chain. There are so many critical, strategic metals and minerals that are bordering on a deficit or already in a deficit. The last 15 years they've largely been shunned and forgotten about, left for dead. But now all of this, plus the robotics boom, the needed larger infrastructure upgrades around the world, including the hundreds of millions in the Asian circle that are being raised up from the poor to the consumer class over the coming years. There's just, in aggregate, there's a historic level of need for critical metals and minerals. And we have this increasingly bifurcated world. We have a situation where a producing mine takes 15 to 20 years to come online. There has not been a capex or mining life cycle to achieve these needed natural resources for the last 15 to 20 years. And we need them. Where will all of these critical metals and minerals come from? Won't prices have to just rise so much higher to levels that won't only begin incentivizing supply, but also to kick off a historic mining capex cycle here?
Oh, yes. I mean, as I mentioned earlier in the interview, I think we've underinvested in commodities and minerals, especially, and oil, energy, natural gas, etc., nuclear. There's been all sorts of underinvestment because of our eyes have been bewitched by the environmentalists telling us that everything's going to be electric and everything's going to come from the sun, which is total baloney. And, and so now we're in this situation, and the market would be preparing for higher prices and diminishing reserves and all that kind of stuff by recycling and by looking out for newer and newer sources of these things. But that's, that didn't happen. That's in the past. And so right now, as you suggest, it's very difficult to increase the supply of something like silver. And actually, most of the supply of silver is a byproduct of other metals. Exactly. So if those mining industries shut down, I mean, the silver market would be completely choked off. And now, of course, the U.S. is making it a strategic mineral. China is making it a strategic asset.
They just banned exports of silver. I think it was within the last few days.
Yeah, and that's trouble because they refine and process most of the silver. And so, if it goes through there, I'm not sure if it's ever going to get back out.
Right.
And we need it. We need it for so many of the neatest things. I mean, all of our neat gadgets and all of our high technology,
and our military and defense.
Yeah, I mean, everything that's really, really important. And most Americans don't understand this. They don't know what's inside their smartphone. They don't know what's inside the windmill or the, cruise missile or, all this other stuff. But it's really, really important. And if we can't have a supply reaction to an increase in demand or just a sustained demand for something like silver, which apparently has been in a supply deficit already, then the only way the market can adjust is higher prices. And I think, as silver approached $50, I was saying that, we're going to experience growing pains in this market now that we've reached a new level. And we've seen all sorts of, issues come up in this marketplace, backwardation, supply shortages, backing up at the refineries, metals being flown across the Atlantic.
The overheating of the coma. Don't forget that.
Yeah, in Chicago where it's freezing outside.
Exactly.
Open the windows, guys. Open the windows. Yeah, I
mean, to your point on how silver is largely a byproduct of other mining activities, lead, zinc, gold, copper, et cetera, 70 to 80%. In the early 2000s, there was a Chinese boom, economic boom taking place. They had an infrastructure boom. So mining activities were ramping up during that time in copper, lead, zinc, et cetera, to meet those needs, which led to higher output in silver. That's not happening today.
Yeah. And the price of lead and zinc and aluminum starting around 2003 because of the real estate bubble around the globe and the infrastructure bubble in India and China, those metals went really high in price, which created supply of silver that wasn't really experiencing increase in demand. So silver prices were kind of artificially suppressed for a very long time. And now we're seeing a reaction to that. And but in the meantime, of course, there was no investment in silver mines, or even technologies to recover silver and that sort of thing. So we weren't really doing the work that we are going to be doing right now. People are going to find all sorts of new ways to, go through landfills and, acquire old electronics and try to recycle, teeny bits of silver all over the place. I expect there to be a frenzy as the price of silver, explodes higher. People are going to be looking for ways to find silver other than going, out in the middle of nowhere and digging a hole in the ground.
I agree.
So, yeah, I definitely see that's a problem. And I'm sure, because what we're seeing is that at the local coin shops, people are selling their silver, and that silver is being sent to a refinery to make into large bars. So there are people, maybe Bill Gates and Elon Musk, who are buying, millions of pounds of silver in anticipation of all this. So the smart money, I think, is at work right now, and they see the problem. They've seen the problem, and they're taking steps right now, and that's caused this backflow through the supply chain of silver from the little guy at the retail level back up through to the wholesale level. So we're getting, instead of giant bars coming in from the mines and being broken down and sold as coins and little bars and jewelry to the general public, now it's backflowing back up to the top, into the hands of the smart money, the big money, the people who realize that high tech is dependent upon silver.
Mark, I'd be remiss if, while we're on this, having this discussion, that I don't ask you a positive question here. So as you look out over the horizon, the next several years, which are going to bring incredible change with the global power structure, the onslaught of AI and robotics, the changing of the guard from the baby boomers to the younger generations, what has you highly encouraged and excited?
Oh, well, I'm definitely very optimistic. I mean, when I got into economics at the beginning, it was awful. There were no Austrian economists. They were almost all dead. And nobody had heard of Austrian economics. And now millions and millions of people call themselves Austrian economists now, or that they support Austrian economics. And, the young people in particular, they do not like the way that we have managed things. They see that they're being disadvantaged. So the next generation, there's a lot of socialists there too, but the smart ones are, followers of the Austrian school and smart stuff. And, of course, the whole environmental frenzy of global warming, that's starting to melt away. And,
good use of term there.
And political, and political parties are starting to operate around the world that are in opposition to the statist, socialist, Keynesian, environmentalist agenda, which is, obviously not good for the common man. And so I see it every day. We're here to teach not just being pro-free market or just being anti-government. We're here to teach kids who want to learn. They want to learn, how do markets work and why does government always fail even though they're trying really hard? They want to know those things. And when enough people know how the market works and how government always screws things up, then, we set the stage for a renaissance.
Sounds wonderful.
Of society where government is no longer important or is not as important as it is now, but society can flourish. Independent individuals working, thinking, growing, developing on their own accord, hopefully, having more families and more babies and more businesses and being entrepreneurial and being community oriented instead of, spending time on your phone alone.
Well, if what we're going to experience soon, whether that's in 26, 27, 28, I don't know, this brick wall moment, if that's what's waiting for us on the other side of that, that sounds wonderful, and I'm hopeful for that. This has been an incredible discussion. I want to welcome everyone who's tuning in to this fantastic interview with Dr. Mark Thornton, Austrian economist and senior fellow at the Mises Institute. Before we wrap up here with our final set of questions for Mark, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metals&miners.substack.com. Join the quickly growing community and receive a free report. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. That's a famous quote by investing legend Ray Dalio. That's also the name of the report you'll receive. I'm also positive you've been enjoying the conversation Mark and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. Mark, let's finish off here with you sharing a key takeaway that you want viewers to keep in mind, and then let everybody know where they can learn more about your work and how they can connect with you.
Well, the key takeaway is that markets have not been allowed to work properly for decades now, and we're starting to see the fruits of the socialists and the Keynesians bear fruit, and the fruit is nasty and poisonous, as we can all see. And I think that lesson is going to become even clearer in 2026 and going forward. So just remember that that's not, everybody always wants to blame the free market. Well, it's not the free market.
Right.
And Austrian economists have done a remarkable job in developing a theoretical approach of how to understand how the market works at the individual realistic level, rather than some kind of mathematical, statistical, formula that is supposed to show how society functions. And one of the great Austrian economists, Ludwig von Mises, the namesake of the Institute, one of his greatest students was Friedrich von Hayek, who studied with Mises in Vienna and went on to develop a lot of Mises's ideas. He went on to win the Nobel Prize, and he wrote a best-selling book during World War II called The Road to Serfdom, which unfortunately was, even though it was read a lot at the time and it made a big impact on people around the world, it was ignored. And so the Institute has brought out a new book which contains Hayek's greatest hits articles, and we're willing to send everybody a free copy. I'll put the link, I'll give Gary the link where you can write and get a free copy, or download it electronically, or download the ebook version. And it contains some of his most illuminating articles of all time. And remember that Hayek came out of retirement in during the stagflation of the 1970s, and he was the ideological backbone for Margaret Thatcher in the UK and Ronald Reagan in the United States. And both countries and all the Anglo world actually experienced a tremendous increase in prosperity. And of course, we brought about the downfall of communism in the Soviet Union and in China. And so Hayek really matters, and this short book has some of his best stuff. And I encourage everybody to get a copy and read it and learn how markets work.
All right. And is there a website URL and are you guys on X?
Oh yeah, I'm on X at Dr. Mark Thornton. Mises is on there. Mises Media is on there. All of our scholars and staff who write and have podcasts. We have 5 podcasts. We have daily articles, so many that I can't keep up with it all. We have 2 academic journals, a book publishing operation. We have conferences for high school students, college students, graduate students.
What's the website?
It's Mises.org, MISES.org, and it's one of the largest economic web pages in the world. It's one of the most trafficked, and it's all written for regular people. It's not abstract and mathematical. It's all very much where the rubber hits the road in everyday issues. At base, there's academic and theoretical reasons, but we address every ongoing issue that's out there from the perspective of Austrian economics and libertarian political theory.
Wonderful. Well, I'll have all of the information up on the screen. If you get me that link you were talking about, I'll make sure that's there. It'll also be in the description area, guys, so that you can click on it and click through. You can go ahead and get over to the download. You can get to the website. I'll have his X handle also where you can click and get over to it. Take advantage. There's a lot of information there. a lot of education. It's worth your time. Mark, thank you for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's really been wonderful to spend the time with you, and I look forward to having you back on sometime soon. Everybody else, thank you for watching. I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report you'll receive.